Thanks for checking out this video from NetPicks. And before we get started, hit that subscribe button and like this video. And today we're going to talk about protecting your trading capital, which is the most important thing that you can do as a trader. And also, don't forget to download this free price pattern guide. It's probably been one of the most successful and popular free guides we've ever put out. The link is above and below in the description. So what does that mean by protecting your trading capital? Well, it basically means make sure you set a protective stop loss on every single trade you make. For those that are wondering, what is a stop loss? It's just a predetermined point at which you're going to sell a security, whatever you're trading, to limit your losses if and when price moves against you. There's a variation of the standard stop loss. It's a trailing stop, and that would just be used to lock in profits as price goes in your direction. But we're going to talk about setting a protective stop loss and why they are really important. So as mentioned, it's to sell your security when it reaches a certain point. And this is typically, unless you're using a trailing stop, used to limit how much you're going to lose on your trade or your investment, whatever it is. So for example, let's say you buy a stock for $100 and you place your protective stop loss at $95. Well, the broker's going to sell the stock if it falls to that $95 level. So in that case, you're going to lose $5. But also, we mentioned trailing stops, and you can use stop losses to lock in profits when the trade's going in your favor. So let's say you buy the same stock for $100, and then it goes to $120. So now you raise your initial protective stop loss to $115. So obviously, the stock would be sold if it goes back to that level, but you're still going to profit on it. So it's so simple to set a stop. There's absolutely no reason that you should be trading without one. And some traders are going to use a mental stop. But the bottom line is they do have a price point that they're going to get out. So why is it important? Not just to limit losses, because nothing is certain in trading, right? It's an essential tool. So look at this losing streak chart. That shows the probabilities of you taking a loss. So you're going to take losses. You're going to take losses in a row. You can see here with a 40% win rate, you could take up to 25 losses in a row. The average is 8. So if you fail to manage your risk and you let those losing trades become too large, could you recover? Well, look at the gains that you need during certain drawdown levels. If your account goes down 50%, you got to make a 100% gain. If it's down 75%, 300% gain. Just imagine your trading produces 60% win rate and you were 100% guaranteed to take 4 losing trades in a row sometime in the future. Also consider that each loss is 15% drawdown in your capital. I think we can agree that coming back to trade another day, it's pretty slim, and I think your trading career would be done. So how do you set it? Well, if you've accepted the obvious risks in trading, you accept that you need a protective stop. And no matter how much research you do or how confident you are in a trade, there's always that potential for losses. That is why it's important to have a plan in place to how to deal with that. And your stop loss is that plan. But how do you determine where to put it? There's a few factors you can consider. First, look at the overall trend of the market. So if it's on a steady decline, but we're still holding an overall uptrend and you're looking to get long, you might set your stop a little bit lower than you would if the market was strongly moving in your direction. You also have to think about your own risk tolerance and your ability to see the market go against you. So if you're more risk adverse, you'll probably want to set your stop close to the current market price. Tighter stops to your entry, they do have benefits for position sizing, of course, but it is also at risk of multiple stop outs the closer it is. Finally, you have to consider the specifics of whatever you're trading. If it's a volatile instrument, you probably want to set your stop loss further away from price to give it a bit more room to fluctuate. Now, the ATR indicator, don't overlook it. It's a very helpful tool when you want to set a stop. Essentially, the ATR measures the volatility of an instrument over time, and that can help you gauge how far away from current price you should set your stop. So for example, if the ATR is showing that a security is very volatile at this particular point in time, you may want to set your stop loss further away from current price to give it a bit more room to fluctuate. So here in this chart, you can see that on the left, the average true range is showing a fairly steady reading. And then from the middle of the chart to the right, we have a rapid increase in the ATR, $6. So that shows the instrument has increased in volatility. So you're going to want to give your stop some breathing room. But you can also see on the right side, the candles have a larger range than the ones on the left side. So if you use the same stop distance for both sides of this chart, you're going to get some faster losses for sure. Also note that a rise in the ATR could also be pointing to an exhaustion in the instrument. So you should always be ready for a potential reversal against you. On the flip side, if the ATR is showing a security is not very volatile, you may want to move your stop closer to current price. So I'm going to give you just one popular strategy to use when you set your stop loss with the ATR. So here, price pulled back into a previous area of resistance and now potentially support. We have a hammer reversal candle. So for this example, we're just going to assume that you buy stop the high at $23.05. Well, our ATR reading at that time was $1.59. So if you're using a 1 times ATR, the calculation would simply be your entry price of $23.05 minus the $1.59. It's the 1 times ATR. And you'd put your stop at the support level. That's that faint red line you can barely see. But with 1 times your ATR, it actually puts you in the noise of the instrument. So I would consider 1.5 to 2 times the ATR. And you can see here the ATR that's 2 times, it's far from your entry price, right? And you can adjust that once price moves in your direction, of course. It's just one tool. It's an important tool that you can use to set your stop loss. But you also want to factor in other stuff we talked about like trend and volatility. Another popular method is simply swing highs, swing lows. So this just involves placing your stop loss at a level below the most recent swing low or above the most recent swing high if you're short. So for example, let's say you're looking at this chart and the most recent swing low is $100. You would place your stop loss at a level below that, like $95. So how far under that swing low are you going to place it? Well, in trading, we want to keep things as objective as we can so we can combine the ATR reading with that. So again, in this example here, price retraced to a former support level, and it actually put in a bullish engulfing candlestick. So a trader enters a buy stop order above that bullish engulfing candle, sets their stop loss at the low of the candle minus 20% of the ATR. So the price would be $35.95 minus 0.20, which is 20% of the ATR, which is 0.83, which would give you $35.78 is where you'd put your stop loss trigger. You could use any percentage of the ATR you want, but remember that you're subtracting it from the low of the candle when you go long. If you put it too far away, you're going to have a smaller position size. 20 to 50% of the ATR, not a bad starting point to start testing. Again, we still want to consider all the other factors we talked about with trend and volatility. It's pretty simple. A stop loss is simple, but it's one of the most important tools you can use. Make sure you set your stop loss. We talked about 2 different ways to set it, using the ATR and swing high and swing low zones. But whatever method you're going to use, you got to do it on every single time that you risk money in the market. The bottom line is protecting your capital. You want long-term success. This is vital. So my question to you, are you protecting your trading account with stop losses every single time? If you're not, start today.